Hello and welcome to this brief tutorial that explains the bull-bear profit strategy and approach to stock trading. We'll cover 6 well-known stocks to show the strategy in action. Getting right to it, when it comes to making money, bull-bear profit educates traders to do 3 things. Avoid losses, most important. Number 2, create profits. And 3, use the emotion of the stockholders to accomplish number 1 and number 2. We believe it is more important to not lose money than it is to create profits. If you can master how not to lose money, the only thing left is profits. Here are 3 critical facts why the bull-bear profit strategy cannot be wrong. A stock's price is never wrong. Number 2, ultimately a stock's price is shareholders' emotion in action. That's very critical to the strategy. Number 3, stocks always reverse direction under extreme emotion. Bull-bear profits golden rules. Number 1, never speculate on price. Trade based on facts. Number 2, don't be greedy. Take what the stock gives you. Number 3, profit with stock movement. Never fight it. And number 4, base all trades on price and shareholder emotion, not personal emotion, to eliminate speculation. Ultimately, speculation are opinions. This here is a funnel of a quick example of speculations. Ultimately, all this comes down to price. It all boils down to price. So let's see the strategy in action. We'll start with Apple Computer, and 2 things we need to understand and how to read the chart. This is a 1-day chart, and what is important to understand is what convergence and divergence is. Very simply, converging is when things move together. These pink lines, this is converging with this line. They're both moving up. And divergence is moving in the opposite direction. This yellow line is moving down, as you could see, and this line is moving up, so that is diverging. So the next thing is to understand 1, divergence. Use divergence to detect a change in extreme emotion. I want to point out divergence and extreme emotion. That's where we make our price moves. So we look back here, take a step back. This is of course prices, and this is what we call our emotional indicator. This just tells us when the emotion of the investors is changing and to pay attention for when to get into a stock. When things are converging, we do not do anything. It's just confirming price is moving up, the emotion of the stock is moving up, and when things are moving up, that's a very optimistic view of the stock. So I would not trade. Once again, we're into divergence. So the same thing here happens. It's converging, moving up, moving up. Now we're moving down. This is important. This is an extreme because it's a new low. So from here to here, even though the price is moving down, the emotion is moving up. This is an excellent time to get into the stock. And here's your example. This technically was an entrance right here. We could have waited and actually added to our investment because the price continued to move down, but our indicator moved up. Even stronger confirmation that the trend is going to change, and sure enough, it changed. In fact, it nailed the bottom for quite some time, a long time. And that went on for nine almost 10 months. And that move was a 51% move. Not bad. On to the next stock. We're going to cover Amazon. Amazon, this had a couple possibilities here. All the lines I'm showing on this stock are divergence. So here is our first extreme, and it moved up. Why I call it an extreme? Extremes are either price or extremes in emotion. This was an extreme in emotion. This was the first part of the emotion. Obviously, it's going down. A lot of pessimism in this stock that it's going down, but they're telling you that the trend is changing. Even though the emotion, and it starts right here, is going down, this is going down, emotion is going down, but the price overall is moving up, and it's a divergence. So this is telling you right here there's going to be a shift in the emotion of the stock. Excellent time to get in, and it absolutely gave you some profits. Don't be greedy. Take what the stock gives you. You can enter in on the reversal. A reversal is when something changes. This is a great example of a reversal, is when it reverses in price. Here the emotion reverses from bullish to bearish. Here the emotion reverses from bearish to bullish. So here there's another divergence and another extreme, because these emotional indicators is getting even further down. It's the most extreme up to this point in time. From looking back, this is the most extreme emotion. So bottom line is, excellent time to get in. Once again, this nailed it. This nailed the bottom. The stock never looked back. Outstanding trade. On to the next stock, Facebook. Here's an extreme. Here's an extreme. Wait for the next extreme to happen, which did not occur till right here. We'll take a peek at the stock. This is saying it's going to go up. This is telling you it's going to go up. And boy, did it ever shoot up. And that also, in this area, nailed the bottom. And this continued to go up, never looked back. On to Google. Here we go. This is detecting a change in emotion because price is going down, emotion's going up. Long story short, that's the reversal. And there you go. There is your profits. That is what we trade on. That's our strategy. Two more examples. Microsoft. Take a look at the big picture here. Obviously, the trend is moving up. Okay, let's look for an extreme. Here's an extreme. Another extreme would be the emotional indicator at or equal to this particular setting, which here is negative 273, is where this line is here. We'll look to see if there's anything close to 273, 262. Now we're getting to the next extreme in emotion. Let's just take a look at price. Price is obviously moving up. If you're comparing this point to this point, price is obviously moving up right here. Here's another great time, an opportunity to take some profits. Get in the trade right here. Price definitely gave you some profits here. 3% continued to move up. 4%. Take what the stock gives you. Don't get greedy. Move on to the next trade. If you look at a micro area here, where this is an extreme because it's a new low relative to here. What happened? Momentum shifted up. Enter the stock right here. That would have been an excellent opportunity for obviously a lot of profit here. And that is an example for Microsoft. Last example is for Twitter. Here there's a divergence. There could have been some profit, a little bit of profit over here. Just take profit on the next day. This is a daily chart. You could take profit here, take profit here. 6.79% isn't bad in 2 days. Here we have more divergence. The more a stock moves down and the more rapid a stock moves down, typically the higher it's going to jump back up. So this is given pretty steep right here from this price to this price. This is telling you the emotion has changed, the momentum's changed, and it's going to come up right there. Excellent time to get in. The stock has a new extreme down here. Once again, the importance of extremes. This is low, a brand new low. There's another extreme. This is a reversal. That's why I'm picking that point. The next reversal is another extreme, another extreme. Eventually, the investors, there's going to be a bottom and people are going to pick it up. The big bucks come in and start to lift this stock up. And this detected right here. The momentum, if you notice, even though this came down, the momentum kept coming up, 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 and up. Entering the trade anywhere in this area would have been outstanding. And that nailed the bottom. That concludes it, and that's our strategy, is seeing emotion in action and the importance of divergence. It works. It has to work, and it never fails. We've never seen a stock where this has not worked. For more information, please use our contact page, call us, set up a live one-on-one session, or email us and sign up, and we will give you a free stock trade education. And you won't believe what we give away for free. Thank you for listening.